we're in a period now where macro has become much more important. I mean, we're dealing with inflation for the first time in a really long time. We're dealing with a lot of stuff. I mean, people assumed, for 40 years, our stocks and our bonds did great for us and we didn't have to really worry about it. And
Right.
now we're kind of in a different world. So just to set the landscape, I'm wondering if you could just talk about where we are right now. I mean, obviously we had inflation that got really high. It's come down somewhat, at least. The Fed is still hiking. The market is expecting the Fed to be easing, I guess, by the end of the year. I'm wondering if you could just give us an overall view of where you think we are right now.
Yeah, I think one of the things, the challenges of a macro perspective, say versus a factor investor's perspective, quant factor investor's perspective, is the sample size is just like so low relative to, if you're a quant factor investor, right, you can invest in like 5,000 stocks on as frequent as like a daily basis for the last 30 years, right? The sample size is just so high. When you think about the macro economy and you sort of the simplified macro economy, there's really, in the US, there's been like 10 cycles over the last, 10 data points over the course of the last 75-ish years. And so I think part of what you have to do as a macro investor is you have to start to build the intuition about how these linkages work. And so if we think about where we are today in the cycle, in a lot of ways, what we're experiencing right now is a very typical late cycle dynamic. And what I mean by that is we have unemployment, or the labor markets are relatively tight. The outcome of that is elevated inflation. The central bank responded to that by tightening. The Fed responded, but also the ECB and the BOE and others responded by tightening. The way in which we got here was like a little abnormal in the sense of we had a relatively substantial, fiscal stimulation coming out of a crisis period. But the conditions, the dynamics that we're in right now are very normal late cycle. And what I'd add is they're normal late cycle of a type of late cycle environment that is not similar to the late cycles that most of us have seen in our investing careers. Most of us have seen credit cycles, credit-driven cycles. '08 was a credit-driven cycle. Even, to some extent, 2000 was a credit-driven cycle. Earlier than that, we saw credit-driven cycles in the early 90s. What we see today is not a credit-driven cycle, but an income-driven cycle, a nominal income growth-driven cycle. And I think that's a very important dynamic because the way in which those cycles end is a bit different and the sensitivity to tightening is a bit different than a typical credit cycle, right? Typically what happens is you raise interest rates, people go from borrowing a lot to not borrowing. That shift in borrowing a lot to not borrowing is what ends up slowing the economy. Well, what we had here, and combined with the fact that interest rates rise, which means that people spend more on interest payments, which means that they then, have less money for consumption. What we're seeing right now is actually a very different story. We've been in what's described as the deleveraging for a long time, which is that households and businesses have been reducing the amount of debt relative to their income or relative to their expected profits or EBITDA for a long time, right? Since really the financial crisis. And so what you have here is there wasn't that much credit growth coming into this late cycle. So the tightening that has occurred from the Fed hasn't mattered that much because the slowing of credit has been much less substantial than previous cycles. And then number two is the massive amount of liquidity that was in the system allowed basically all borrowers in the non-financial sector, corporates and households, to term out their borrowing at very low interest rates. And so that effect, which is like the typical impact on profits or on household spending that comes from rising interest rates, that hasn't occurred in this cycle, right? Because if you're sitting on your 2% mortgage, you're paying a 2% mortgage, right? Literally, the Fed could raise interest rates to 1,000% and you would pay a 2% mortgage. And that's the issue, is that the sensitivity of the economy to the Fed tightening in this cycle is very low relative to the typical sensitivity that we've come to know, particularly like in the '08 period. And so the result is that, we're seeing this late cycle dynamic, but it's moving glacially slow relative to what most of us have experienced in our careers, right? If you had told people 14 months ago, hey, what's going to happen is the Fed is going to do, almost 100 billion a month of QT, and they're going to tighten interest rates 500 basis points, and growth was going to be 2% real, and inflation was going to be 5%, and employment was going to put up up 200,000 to 300,000 jobs a month, I think people would have thought you were totally nuts. I certainly said that to me on the internet when I suggested that could possibly happen, right? But that's the reality, and that reflects the fact that the economy just is a lot less sensitive to the Fed's policy than it has been in most of our experience.